Good morning, ladies and gentlemen, and welcome to TaxCraft. TaxCraft is Ichiban's quarterly tax call, where we go through the developments of the last quarter and see how these are affecting us and our businesses. My name is Carol Kariuki. I'm the CEO of Ichiban Tax and Business Advisory LLP, and it's a pleasure to have you here. So without further ado, I'd like to introduce my colleague, Robert, to take us through the developments. Karibu, Robert.
Thank you. Thank you very much, Carol. And always a pleasure, ladies and gentlemen. We've had a very busy quarter three, and we certainly look forward to an even busier quarter four. And we'll be discussing those developments in a minute. And in terms of the outline for today's discussion, we'll be looking at those developments in the quarter to September 2024. And that was hallmarked, or one of the biggest developments was the Finance Bill 2024, which was not signed into law. And so the question is, what next? And then, as always, we look at the recent case law so that you can advise us on the recent developments and what you and I need to be aware of. So in terms of the developments for quarter three 2024, I think one of the biggest issues that came up was the Court of Appeal decision in the National Assembly versus Okiya Omtata. You'll recall that the High Court had ruled that the Finance Act 2023 was unconstitutional, and therefore the National Assembly appealed that to the High Court of Appeal. Now, the Court of Appeal, for amongst other things, not having public participation, and that was a very, very, very big development. And that came on the back of the advisory by the Speaker of the National Assembly on 25th of July, where he guided that there is no bill for submission to the President for assent, meaning that the Finance Bill 2024 is now completely out of the way and cannot be signed. So there's no bill. And what does that mean? That meant that immediately, with 43 billion shillings going out of the budget 2024-2025. Now, it's important to understand that prior to the budget, the deficit was 590 billion shillings. That was about 3.3% of our GDP. After the finance bill was declined, the supplementary budget resulted into a deficit of 4.3%. Why is this important? It is important because under the IMF program, our ceiling for budget budget deficit is 4.4%. So we are really operating a very thin margin. And as a result of all those developments, we then saw the credit rating agencies globally downgrading Kenya as a country. So we had the S&P, we had Fitch, and Moody's all downgrading us in saying, we have looked at the revenue projections, and we are doubtful that you have sufficient revenues to meet your expenditure needs. And as a result of that, we had the credit rating downgrades. Now, even as that is happening, we then had the National Treasury and the CS National Treasury and the Speaker of the National Assembly moving to the Supreme Court. Remember, the Court of Appeal has already decided that the Finance Act 2023 is unconstitutional. So the CS National Treasury went to the Supreme Court and said, we need a stay of execution. And indeed, on 20th of August 2024, the Supreme Court issued a ruling saying the Finance Act 2023 continues operations and until there's a final decision or determination by the Supreme Court. So as we stand, ladies and gentlemen, today, the Finance Act 2023 continues to operate as if nothing has happened. But with all that, we then have the question about what do we expect to see? Number one, there's already a Tax Procedures Amendment Bill 2024, and that brings in the extension of the tax amnesty. And you'll recall that the tax amnesty that had come in the Finance Act 2023 lapsed on 30th of June 2024. And so there's a proposal to extend that probably to June 2025. And the anticipation is that KRA will collect an additional 32 billion shillings. Even as that is going on, there is a proposal to bring back the waiver and abandonment provisions of tax. Again, these ones had been deleted by the Finance Act 2023. And so it's probably a good thing because some debts are not actually recoverable, and therefore we would need a statutory provision to facilitate that. And then there's been a lot of talk around VAT rationalization. As a country, our tax expenditure is about 3% of GDP, slightly higher than the African average. And when you talk about tax expenditure, you're talking about the goods and services that are zero rated, medicaments, and basic goods and services. And so there's a move to review that listing of VAT zero rated items and VAT exempt items so that those can be reduced and we can reduce the amount of VAT expenditure. The VAT expenditure um, consists of about 400 billion shillings just on VAT alone. So you can see that's a big number that everybody is looking at. And then lastly, the one thing that the government was hoping to derive some revenues from was privatization of state-owned enterprises, and particularly the poster boy of these ones would be the sugar companies. And so the idea was we shall privatize these entities and government will get out of doing business. Now, that was to be done under the Privatization Act 2023, which has, however, been declared unconstitutional, and this was last month. And so there's a question about can these entities be privatized in the absence of this Privatization Act, which was declared unconstitutional on the basis that there wasn't public participation. So that's something that you are waiting to see how that progresses. Please register your employees. And that is because the NHIF will transition from 30th of September. So actually now in October, we are now under SHIF. And if you look at today's papers, you will see that I was just looking at today's papers here. There are significant issues in terms of the rollout. However, we've had the leadership of SHIF saying that NHIF will operate together or alongside SHIF for an extended period of time for purposes of ensuring that it's rolled out properly. However, what does this mean for you and I? It means that in October, we'll pay 2.75% of our gross earnings in terms of SHIF contributions, and those ones will be collected by SHIF. And then you and I and anybody who is a Kenyan citizen is required to register as a member of SHIF, because without that registration, then you cannot access some of these services. Then we also saw Revenue Authority moving to probably align with international best practice. And this is to do with the basis or the base that is used to compute the duty when you import a car. So currently we use what is called current retail selling price, CRSP. And the move or the proposal is to move that to transactional value. And what does this mean in practical terms? If I import a car and I buy that car, say, for $3,000, then I should pay duty based on that $3,000. It doesn't matter what the current retail selling price of that car is. And so we are hoping to see that coming through, because the public participation period was to end in October. So we'll wait and see what that is. But an even more interesting one here is the notice about the public notice on fiscal augmentation by the Ministry of Environment. Now, when you look at that public notice, which was inviting comments, really, this to us, or at least to me, sounds like it's a return of the eco levy, because what the Ministry of Environment is saying, there are certain things that are negatively impacting the environment, and we want to raise sufficient funds to address those negative challenges. And how do we do that? By imposing a levy. If you recall the Finance Bill 2024, that was one of the biggest issues, the eco levy that is imposed on imported products. So the public participation has closed. We are now waiting to see what the proposals that were put forth are, but it will be very interesting to see whether that will result in an eco levy coming back. Then from a Kenyan perspective as well, we have an interesting development here in terms of the economic partnership agreement that Kenya had signed with the UK. If you remember, this was signed in 2021, and the idea was that Kenyan exports into the UK should be able to access that market on a duty-free basis, and then we will reciprocate. That is essentially how it works, on a reciprocal basis. And so even though alcohol imports from the UK should ideally be at 35%, they are now enjoying 25% based on that EPA, the Economic Partnership Agreement preferential rate. And then one that will probably impact anybody who is dealing with a public authority or a state-owned enterprise. If you make a supply to that entity, then you will be paying 0.03% of the value of the supply, whether it's goods or services, and that will be paid to the PPRA, Public Procurement Regulatory Authority, effective 1st September. And that will be paid by the procuring entity. And the idea is to build capacity around procurement. And I've just seen in today's Business Daily again, government is moving to e-procurement. So I think they will be able to, we think that they'll be able to trace those transactions quite easily. Now, on the Public Procurement Regulatory Authority levy, it's important to note that if you are late in paying, there'll be a 5% penalty. And then for anybody who has got any loans to employees, the deemed interest rate based on loans which are not subject to any interest, then the rate is 16% for the quarter just ended. We are waiting for the rate to be published for this quarter, but we expect it to be around 15% given the signaling from the central bank about the rate coming down. Then lastly, today is the due date for submissions by the National Treasury or to the National Treasury around legislation to ensure equity and fairness. And you've heard the CS saying, we want to really have a look at the laws in this country around tax. So today is a due date, and if anybody has got any proposals, it will be useful to submit those ones, because we believe that those proposals are what will shape the future of tax legislation going forward around equity, fairness, and ensuring everybody is paying their fair share of taxes. That is due today. Now, a lot of us may be asking, why is all this talk about tax? And I just want us to very quickly look at what the profit and loss of the country would look like, or the income and expenditure. So Revenue Authority is expected to collect about 2.6 trillion shillings this year. Last year, they collected about ordinary revenue, which is taxes, 2.2 trillion. And then they're expected, of the 2.6, we will pay our debts and constitutional offices, 1.2 trillion. We then pay public sector wages of 75 billion shillings a month. That's 900 billion a year. We give counties their 400 billion. We give NGCDF their 68 billion. So in total, we'll expend 2.56 trillion. That means before we even do any repairs, before we buy any flowers, before we buy any tea, before we fuel any cars, we only have 32 billion shillings left for the year. And ladies and gentlemen, that underscores the difficult environment that we are operating in as a country in terms of the fiscal space. We simply do not have fiscal space. And that probably explains why there's a lot of talk around, can we look at how administration of tax is done in this country? Can we have a look at what other countries are doing? Now, and this is the reason why you probably have had what is called the iTax 3.0, which is called the Tax Revenue Administration Management System, TRAMS. And this is ideally meant to digitize revenue collection, and not just for the national government, but we're also talking about county governments probably digitizing that revenue. And so we are likely to go to a new system, which means that Revenue Authority will collect a lot of data around yourself as a taxpayer, and they will essentially pre-populate your tax return. We have already seen that with VAT. They will pre-populate your return, and you as a taxpayer will be saying, I agree that this is correct, or this is not correct for 1, 2, 3 reasons. So that is something to definitely watch out for. From a regional perspective, I think the key development we've seen is the Ethiopia liberalizing its foreign exchange regime, and this is in tandem with expanding their tax base. And one of the things that we noticed about that liberalizing of the foreign exchange regime, the day it was announced, the day before it was announced, it was 57 birrs to the dollar. But immediately after it was announced, it came to 74. Today, it's tracking about 114, 115. So we think that this is probably going to be an improvement in the macros of Ethiopia, and especially anybody who's got operations there. Hopefully, you then be able to extract revenues or profits out of Ethiopia, because that has been a significant problem. And that is backed by the IMF loan and program of about 3.4 billion over 3 years, just like Kenya, essentially. From a South Sudan perspective, we saw the Sudan Revenue Authority moving to reduce chances of pilferage or leakage of revenue by saying we want all goods imported into South Sudan to have the regional electronic cargo tracking system with it, so that if you don't have that, then you'll pay significant penalties on that. if you are to go further afield, Nigeria has been a very interesting one. Why? Because they introduced something which I hope we don't see in Kenya, which is the 50% windfall tax on foreign exchange for banks. So essentially what this means is that as a bank in Ethiopia, you realize a foreign exchange gain because of the volatility of the Naira, 50% tax that is payable by the end of this year. That's an interesting one, and I think we are waiting to see how that will pan out with the banks there. Again, just like we have seen in East Africa and particularly in Kenya, a focus on digital commerce. And the idea here is we're going to tax remote workers because this gig economy is not conforming to the normal income streams that we see, and therefore that we can tax from a pay-as-you-earn perspective, for example. So we're going to tax these remote workers who are in the digital space. And the idea there is to collect about $121 million. And then just last month, the Federal Inland Revenue Service introduced a 7.5% tax on crypto. And this is again based on the volatility of the Naira, as well as the move to crypto trading. And so the VAT rate in Nigeria is, the headline rate is 5%, but they have indicated a 7.5% VAT rate. Now, why is this important? It is because even in Kenya, we also had some taxes on crypto coming in 2023. But more importantly, in Nigeria, the size of the crypto market is $57 billion. So you can see at 7.5%, government of Nigeria is likely to collect quite a significant amount there, and something that we should be watching out for in the region as well. Broadly, from a UN perspective, we had the UN framework on international tax cooperation releasing the terms of reference. And really what the UN is looking at here is just a fair allocation of rights and a focus on taxation of high net worth individuals. This is an interesting one because just this week, we have a team from the Africa Tax Administration Forum, ATAF, in the country looking at or researching on how to tax high net worth individuals. So for those of us in the call who might be high net worth individuals, just know that this is something that the globally is being looked at, and the UN is actually looking at that, and they are looking at it in two protocols. There's what they're calling the priority protocols, where the taxation of high net worth individuals is, and dispute resolution, and then the future protocols talking about climate change and those kind of things. So it's something that we are watching, and we shall definitely see what it means in terms of impacting the tax legislation and landscape in Kenya. So, ladies and gentlemen, as always, we like looking at the recent case law. Why? Because you need to understand what the courts are saying. In fact, in today's Business Daily, we have a case here about M-Copper and their dispute with Revenue Authority, which I thought was quite a good decision by the Tax Appeals Tribunal in favor of the taxpayer. So I will invite my colleague to just take us quickly through the cases that we have, and then we'll take it from there. Christine?
Thank you very much, Robert. It's quite insightful for you to give us the update within the local space, the global space, the regional space on the tax issue that have just come up. Even as we delve into this part, we are now looking at what the courts have been saying in terms of jurisprudence for cases both at the tribunal as well as the High Court. We have talked about the Court of Appeal, and it will be interesting to also see what the other courts have been saying. So to begin off, we'll start with the China Communication Construction Company versus the Commission of Domestic Taxes. The issue here was now in terms of VAT claim that the appellant had made. The question was whether or not at the objection stage, the appellant provided sufficient documentation to support its objection. The tribunal stated that the appellant failed to provide sufficient documentation based on the fact that at the objection stage, the burden of proof was on them. The commissioner did request for documentation. The appellant failed to provide the documentation, and therefore they could not provide the same documentation at the trial stage because their right to provide this documentation was essentially extinguished during the objection stage. For the next case, we'll be looking at the Kenafric Industries Limited case versus the Commission of Domestic Taxes. The issue here was whether or not raw materials are actually subject to excise duty. The excise duty provides for raw materials being exempted in terms of, or you're able to claim against the raw materials cost that you've used in producing the final product. However, the commission was of a different opinion in this case. They told Kenafric, you guys cannot claim for the preforms that you use to produce your bottles. These bottles are what they use to produce their water, non-alcoholic beverages. Under the CEC, clearly, there's a provision for non-alcoholic beverages except alcoholic beverages. So the issue now became whether or not the preforms that KenAfrica was actually importing and claiming against were actually supposed to have the claim for excise duty. The tribunal stated that the excise duty was actually claimable because the preforms are actually being subjected to a further process in terms of manufacture. And during the trial, the appellant raised the definition of what manufacture is. Stated that there was initial, there's intermediate. So during this part, they said there's actually intermediate manufacturing, which means you can bring in a product and then further on carry out further processes and give out the final product, which was the water bottles. This was quite different from the ruling that was given in the Beiersdorf case, because on this one, we had glass bottles that were being imported, and the tribunal stated that there is no further manufacturing going on there, so there was no excise duty claimable. For the third case, we'll be talking about the Solarbetek case. This was with regard to withholding tax on interest. The idea was that whether there is a financial charge on a loan or not, the High Court stated it doesn't matter, because the only thing that is supposed to be considered is the simple definition of a loan. All loans are actually subject to withholding tax, and the interest thereof, whether there was actually a financial charge or a financial benefit, did not really count. For the next case, we'll talk about the Kenya Ports Authority versus the Commission of Domestic Taxes. In this one, we were talking about funding that was coming in from JICA to support the Mombasa Port development, phase 2 of it specifically, and whether or not KPA had an obligation to withhold tax on the income that was being paid to the consultant, that being Japan Port Consultants Limited. The tribunal stated that once again, there is no obligation on KPA, one, to advise Japan, the port consultants, and two, there's no obligation on them to withhold money that they were not in any position to pay or either hold and remit to carry on. So on that, there was no withholding tax on the offshore funding, which is quite a similar situation with the case of KCB versus KRA, as well as the KRA versus Kenya Nat case, in which the tribunal had the same business. On the fifth case, we'll be talking about the Kenya General Industries versus the Commission of Domestic Taxes. The appellant in this case is a manufacturer of iron sheets, and they had withholding VAT credits on their ITAX, and they were also subject to paying VAT. But the question was whether or not KRA's decision to actually offset their VAT against their withholding VAT credits was actually legal. The tribunal in this case stated, one, given that the appellant had actually filed for their refund application a long time ago, KRA had taken more than 90 days to issue their decision. It was not in KRA's power to now come and give conditions as to whether or not the withholding VAT and VAT payable were actually to be used to offset one another. The last case we'll be talking about is the Heritage Insurance Company case versus the Commissioner of Legal Services and Board Coordination. The issue here was whether, first of all, the assessments that were made by KRA were time-barred. The commissioner was of the opinion that the assessments could not be stated to be time-barred because the appellant had not actually brought this out during the objection. The court stated that, first of all, a preliminary objection can be raised at any point in time. This is quite different from the China communication case that we just talked about, because in this one, the appellant is actually allowed to use grounds that they did not use during the objection stage. The second issue in that case was whether the dividends paid by the subsidiary in Tanzania were actually subject to withholding tax in Kenya. And of course, the tribunal of the opinion that the same are not subject to withholding tax in Kenya. Back to you, Robert.
Thank you very much, Christine, for giving us that insight. Now, as we move towards the end of this, the question then becomes, what is the outlook of this? And the first thing that we think is going to happen is that we are likely to see an overhaul of the tax legislation, including the administration. So this is why it's important for us to all give our views, especially with regard to the National Treasury Notice of 2024, September 2024, which is due today. Then the next thing that we are likely to see is that with all these proposals and move, we are likely to see a data-driven policy proposal and intervention. So that, for example, we are talking about expanding the tax base. who should we be targeting? At what rate should we be targeting this? And this is important because, for example, in Nigeria, they did a study and they established that of the informal sector, what is called the hard to tax sector, only 3% could pay tax, and therefore they are designing tax interventions. Actually, this week they just released one which exempted, I think, up to 2 million Nigerian nairas from paying tax. So this is the kind of things that we are expecting to see in the near future. Again, increased public participation, and with that, increased public scrutiny around some of the proposals, and including how the revenue and resources are being used. And then focus on counties, own source revenue for counties. Why? Because at the national treasury level or at the national level, there is a squeeze in terms of availability of resources. So these counties will have to actually try to generate their own revenues. And it's a which underscores the problem that we're having. Lastly, is a move towards the harmonization of East Africa tax laws. We have seen the East Africa Community Customs Management Act, ICMA, for customs purposes applying across the region. There's been a lot of work that is going on around excise duty, and we think that this is going to be coming in quite shortly or in due course, where we have an excise duty that applies across the region, which is about 8 countries. And then thereafter, we'll see VAT. And probably that explains why even in the medium-term revenue strategy, we're talking about a reduction, a potential reduction in VAT rates. So ladies and gentlemen, we think it's going to be a very busy Q3 or Q4 and probably Q1 2025 as some of these changes come in, and even as we go into the budget making process for next year. With that, ladies and gentlemen, I'll hand it back to Carol. Thank you very much for your time and happy to take questions. Carol?
All right. So thank you very much, Robert. And indeed, it has been a busy season in the tax world, and we expect that it shall continue to be busy. So please, ladies and gentlemen, put in your questions in the chat so that we can get to answer them. But even as we do that, I think we cannot ignore the elephant in the room. Everyone is talking about SHIF and SHAP. So Robert, for very many of us in the room who are employers or employees, we wonder what is going to happen at the end of the month. Currently, we are looking at people trying to register, some successful, some not so successful. We also have situations of people trying to get their benefits. And the end of the month is not too far, as we all know. So what happens if our employees or we as employees are not able to get the registrations done by the time we're getting to the end of the month?
Yeah, that's a good question, Carol. And it's one that we're also watching quite keenly because it's not very clear what's going to happen. However, the one thing that we hope is that nobody gets sick because, and therefore you will not need to go to hospital and access some of these services. Because if you do, then at least from what we are seeing in today's dailies, without that SHIF registration, you are unable to access those services. And so it'll really be a question of you are paying or you are not even able to pay because you've not registered and therefore you cannot access. And one of the things that we are watching keenly is what the acting CEO said, that these two systems will run in parallel. Again, in today's dailies, the implementation is really something that we need to get right as a country because the MPs are querying the cost of the implementation. Should we have waited? Should we have run them in parallel? Maybe. Some lessons there to learn. Carol?
All right, thank you very much. Also have a question around the tax amendment bill. So you did indicate some certain, can I say, benefits or procedures that we are expecting around the tax amnesty, around waiver and abandonment. Do we have any timelines or possible timelines around this bill?
So that's a good question as well. So that's the tax procedures amendment bill, which was published in August. Interestingly, with all these problems around public participation, we have not seen any notice on public participation. And so we're waiting to see from National Treasury when can people give their comments around it. And one of the comments that we'll definitely be giving as Ichiban and hopefully as accountants is the amnesty should be extended to cover up to December 2023. The way it's currently worded, it only covers up to December 2022. So we think that it only makes sense for the amnesty to extend up to December 2023 at least, so that people then have a clean cut with regard to any disclosure that they make. But are there any timelines? No, we've not seen any timelines. There is also talk around just retrieving that entire bill and coming up with a more comprehensive tax amendment bill, almost like a finance bill. So we are waiting to see what will happen. Carol?
All right, thank you very much. So even as we continue to seek further clarifications, still waiting for your questions, seeing a couple of them coming in. Do let us know what you're thinking about, what is on your mind around tax, how can we help? So let's move into a question here around the Finance Act 2023. So what happens? We've seen a lot, we've become a highly litigious society, and we are deeming everything unconstitutional. So what happens if the Finance Act 2023 is declared unconstitutional?
First of all, this issue is in court, and that's a good question, Martha. But this issue is in court, and as a lawyer, we cannot really comment on these matters. However, my own view is that the Supreme Court will declare a few provisions of the Finance Act unconstitutional, and then the majority of the act will be deemed constitutional, and it will continue operating as if nothing happened. That's the way I think it will pan out. If it's declared unconstitutional in totality, then there's a lot of issues around changing systems. Your banks had already sent notices telling people we're going to start charging you excess duty at 20% instead of the 15%. And so there'll be a lot of I think uncertainty in the tax environment, and this is what the Supreme Court is trying to avoid. And indeed, the Court of Appeal did indicate that you cannot get a refund even if it's been declared unconstitutional, because the law enjoys a presumption of constitutionality. So even if it's declared unconstitutional, it will be from that day going forward, but it's very, very unlikely in my view. And then I can see a question here by Peter, and this is that you've gotten a notification. I also got a notification, by the way, from NHIF data has been migrated to SHIF. Does one need to do fresh SHIF registration or just update in case of any changes in details? So two things, Peter. In fact, if you look at the statistics that have been released, as of 1st of October, SHIF had registered about 2 million people. And then yesterday, they had registered about 12 or so million, which tells you that they migrated the NHIF data into SHIF, because that's the only thing that can explain that kind of a massive jump. And do you need to register? Yes, under Regulation 11 of the SHIF regulations, you do need to register afresh. It's actually a legal obligation to register. And in the event, you need to register so that you can then access, or your beneficiaries can access the services. Once you register and once you get that SMS, then you log on to Afya Yangu or the SHIF website, and then you can update your details, because not all the details have been captured accurately. Carol?
All right, thank you. And just something here that I know it has been on our minds a lot. There's no current activity, at least within the legal space, around e-Teams, but we do know that there has been many questions around its implementation. What is the current state? What are some of the things that we can expect, especially with the changeover around the Finance Bill 2024 being declared, just being thrown out? Are there things that we need to bear in mind as we continue to implement e-Teams?
Right, very good question. So e-Teams actually came in 2023 via Finance Act 2023, and that's the reason why it was effective. Everybody who is running a business is required to issue an e-Teams invoice effective January 2024, and then you can only support your expenses or you can only take a deduction of your expenses if they are supported by an e-Teams invoice in 2024. You're right. The registration and the rollout has been less than ideal in most people's view, because, for example, the extension was granted too much, and so there's a debate about how do I proof that my expenses were before March and that I should be able to deduct them for income tax purposes. So there's that challenge, but still the uptake hasn't been that great. I think the statistics we saw from Revenue Authority were about 22 or so percent had registered. And there's a real question about how that will be implemented. Will it continue to be implemented? In my view, yes. Why? Because the government is really relying on this to expand the tax base. There's been a lot of talk about the expansion of the tax base. So the government thinks that will help it in terms of visibility of information, and so that is likely to continue. I think the fundamental question then becomes, if everybody's on e-teams, why then do we need withholding VAT? Why do we even need withholding tax? Because then government will have visibility of all these transactions. So probably those are the conversations that we need to be having with government. Carol?
All right, thank you very much. Ladies and gentlemen, we still have time for maybe one or two. So as we see if there's anything else that we could address directly for you. Perhaps, Robert, as we think about the outlook and the way forward, things that are coming up, we do have, it's now 4th of October. We have companies that have September year ends. It's been a year that has been fraught with a lot of changes. What happens to the September year end, especially with regard to things that have not quite been settled and that we're hoping will be settled before the end of this year?
Well, I think the way one would look at it would be deal with the law as it is currently. For example, the Finance Act 2023. If it says you withhold or you're required to, say, for example, have an e-teams, to the extent that it's not yet been resolved, operate as if it has, it's still the proper law, so that when Revenue Authority comes after you, we had this problem in 2011, 2012, when they introduced excise duty on financial services. There was a lot of confusion. And eventually what happened is the KRA went after the banks, the financial institutions, and said, you ought to have been charging excise duty. So for that risk, for purposes of managing that risk, I think it's important that you operate as if the law continues to exist as is until it's declared otherwise.
All right, thank you very much. And we do have a question. So we have a question here from Maxwell Ambiro. And Maxwell, I'd just like to ask you to unmute yourself so that you can proceed and ask.
Thank you, Carol. Good morning.
Good morning, Maxwell.
Hi, Robert. Great to see you. Now, I wish to just ask a general legal question with regard to the TAT rulings. Now, in case where the TAT has knocked off, maybe, has accepted an appeal in terms of the technicality due to, for example, refunds where, for example, the refunds on the timelines basis, but then the substantive issue is not yet addressed. What happens next? Because we've seen cases where KRA is told that you ought to have made an objection decision within the stipulated timelines, thereby making the whole appeal moot. But then what happens to the substantive question? Thank you.
Yes, thanks, Maxwell, and always a pleasure speaking to you. Now, I think two things for me here. One is when you're framing your prayers at the Tax Appeals Tribunal, it's so important to frame those prayers tightly and ask for specific orders. So, for example, in that one, you say, can the respondent be ordered? Can we have an order directing the respondent, in this case, KRA, to process that payment, the VAT refund payment, so that it's very clear what needs to happen after the issue has been decided, even if it's on a preliminary issue, like you've said about the KRA not responding within time. And on that issue of time, it's now become so serious that Revenue Authority, in practice, what they are doing is that once you give them your objection, that day they receive their objection, their 60 days starts running. And in fact, they will not even wait for 60 days. They are probably going to give you within 58 days or 55 days. That's how serious it is. Why? Because the tribunal has ruled that if you do not give an objection decision within 60 days, then by operation of the law, you're deemed to have admitted the objection and accepted, and therefore there's nothing further to argue. So I think in your case, Maxwell, I would probably say that look at the orders, and if the orders were not clear, then probably seek a review of that decision by the tribunal, because the tribunal is empowered to do that under Section 29. Seek a review of that decision and say, can I now have the orders that necessarily follow that decision?
Right. Thank you very much. And looks like things are heating up just as we are winding down. So we do have a couple more questions. I'm seeing a hand going up. Kevin, I'd like to request if you could please put your question into the chat, as we will be needing to close this down in the next minute or so. That way we can get back to you in person at the very least, or put up a response on our socials. So as we bring this discussion to a close, and as Robert gives us his goodbye, maybe Robert, you could just tell us, what do we do if we want to influence tax policy? Where do we take our opinions? And once we're done with that, ladies and gentlemen, we will be bringing this to a close. We would like to thank you very much for joining us this morning. And my colleague Salame will be putting a link on the chat requesting for your feedback. Please provide us with your feedback, as this will give us an opportunity to get better and to address your concerns. So I will be signing off now. And once Robert responds on how we can be more involved, we shall also be signing off there. Thank you very much.
Thanks, Carol. How you can be involved, how we can all be involved. Let's put in our memoranda. There's an email address that National Treasury has given. I think it's submissions at nationaltreasury.go.ke. So let's put in our submissions. We've seen Revenue Authority and National Treasury responding very, very well on posts on X or Twitter. So that's another forum. And then you can always talk to your member of parliament if you've got access to them. You can talk to ISPAC. You can talk to your tax advisor. We all have access to these platforms where we can then provide consolidate that feedback and provide it to National Treasury. In my capacity as the chairman of the Public Finance Committee of ISPAC, then I'm very, very happy to also pick your recommendations, and we can certainly have a conversation with National Treasury. As always, thank you ever so much for joining this call. Always a pleasure to share insights and developments, and we look forward to hosting you at the next TaxCraft. Thank you very much. Carol?
All right. Thank you, Robert. Thank you, ladies and gentlemen. Have yourselves a lovely day. In case you have any further questions, please reach out on email to either Robert or myself on the emails provided. And you can also reach us on our various socials. The handles are provided on the screen. Have yourselves a lovely day. Look forward to seeing you at the beginning of January as we delve into the developments of Q4. Have a great day.